how you did. Any thoughts?
I can say we struggled. I think we were on a call for 4 hours together trying to work things out.
Yeah.
But it was kind of like we were kind of struggling, and then we kind of figured it out. But I can honestly say we worked together as a team really hard.
Okay. All right. Okay. How about anybody from Chester? How'd you guys, how did it work out for you? Anybody here from Chester?
Yeah, very nervous.
Very nervous. And well, you know what? This really was your kind of your first go around, wasn't it? On
Yes.
him. Yeah. And it's not unexpected that on the first go around, the performance is going to be less than what you may have anticipated. Simple reason for that is that still you're trying to navigate through all the different decisions on CapSim, and also you're trying to build your company. So you're spending a bunch of money at the beginning, and you're not generating the revenue yet to offset the expenses that you've been investing in your firm. So my advice to you would be, don't panic. If you position your products correctly and price them correctly, your sales will then, you will generate the sales to generate the profit, and you'll have, you know, a good turnaround. So yeah, don't panic. Don't try and chase your strategy. So let's see here how we did. Andrews, that's your team, right, Rosa? Aren't you on that team? Rosa, yep, you're on Andrews there. All right, return on sales was minus 5.8, return on asset minus 4, return on equity minus 7.8. So these are all of your performance ratios there. Your sales, your asset, and your equity, which simply was meaning that you had invested, either invested more money or you had some inventory that didn't sell. So your return on sales was lower than anticipated. And then return on asset also would have been lower. So if you invested in your firm in any manner, like in innovation or in advertising, promotion, any kind of assets or any kind of capacity, and you didn't have the sales, then your return on asset is going to be down, and so is return on equity. You did have a $5.9 million loan from Big Al. He came out and gave you some money. Yeah, Robert, what's up? Question.
Yeah, I just wanted to comment, like, we really were struggling this week. We really couldn't figure out how to rebound from last week.
Yeah.
And, you know, so I'm not sure, we're not very sure of kind of what we put forth as far as how to go in the right direction and how to fix what we messed up.
Okay.
Or I shouldn't say messed up, but how to correct, you know, make corrections on what we did at the previous round.
Okay.
So like Rosa said, we were on the call for 4 hours one day, a few hours the other day. And we just, overall, it was just, we were on the struggle bus trying to figure out how to, you know, rectify our mistakes. And we just weren't very sure when
Okay.
we turned it in. I
Well,
just
tell
wanted
you
to throw
what,
that out there.
Let's how do I get out of this one here? Wait a minute, hold on a second. What did I do here? I think
We also watched some YouTube and some tutorials, and we tried to, you know, we really put forth quite an effort. So I hope we didn't fall too flat on our face.
No, I'm sure you did. Hold on a second. I think I went out of that. I got to get back on to that. For some reason, I dropped out. Get back on there. Well, I tell you what we'll do here, Robert. We'll take a look at your performance numbers and see if we can find anything that kind of jumps out at us here. All right, I should be back in it now. Let's see if I can share. There it is. All right, now I'm back. You guys can still see this, right? Okay. All right, yeah, a good point there, Robert. So let's take a look at that here in just a second, and we'll see if we can look at the different products you have and how they're positioned. And maybe that will give us an indication of why your sales may have been less than expected. Let's go to here. So continuing on, you had an emergency loan 5.9. Your 5.9. Your sales were 75 million. Earnings before interest and tax was minus 73. Profits were minus 4.3 million. Cum profits, you're still profitable 1.678. You had a good contribution margin, 30.6. Baldwin, return on sales positive 1.7, 1.8 return on asset, 4% return on equity. You had 200 million in sales, 16 million in EBIT, earnings before tax. And then you had profit of 3.3. Cum profit now is 9.7. Your contribution margin is 28%. Baldwin, I got a suspicion here that you probably invested heavily. So we'll take a look at you guys too. Chester, minus 1.6 in return on sales, 1.6 also return on asset, minus 3.1 return on equity. You had $100 million in sales. EBIT was 2.8. Profit minus 1.6. That's really not bad. Cum profit still is 7.8 and contribution margin 28.7. Digby minus 14.5. Return on sales, return on asset minus 8.8, minus 28.8 on return on equity. You also had an emergency loan for 4.7. Sales 82 million. EBIT 7.8 million. Profits minus 11. Oh, what did we do? We'll take a look at you too. Cum profit minus 2.4, contribution margin 24.7. So let's jump down here to your products. Let's take a look here first. Baldwin, yeah. You remember where I was talking about your 1.7 and 1.8 return on sales, return on asset? You invested $40 million in plant improvement. So that is going to generate long-term profits for you. My suspicion then, if you did $40 million in plant improvement, it would be in the area of, let's see, let's go down here. Hope I'm not making anybody dizzy when I do this. You added another line, the bull line, and you did automation. Your low end now is, you got two of them in the low end, is at 6.0, and your traditional is at 4.0. And did we do anything else? TQM, let's see if we did TQM on you. Back up here and see.
It was at the bottom of that balance sheet survey, right
Right
down,
here.
right there. See the other fees, write-offs, TQM bonuses? Is that what you're talking about?
Yeah, where am I? I'm missing it, I guess. I know it's
Just
here.
down, almost to the bottom, right above EBIT.
Right above the, oh, there it is, TQM. Yeah, it's kind of hidden, isn't it? Yeah, you put 2 million in there. Looks like Andrews, you put 250,000 in there, and Digby 994,000 in there. Not a bad thing, because that's going to help. That's going to generate sales for you as well. So investing in TQM is a good solid plan. Let's see what else I can see. All the teams made big investments. Digby 33 million, Chester 8 million. Andrews, you guys put 11 million in. Andrews, you paid off a bond of 7 million. Baldwin's paid off a bond of 5 million. And looks like, what did we do here? So Andrews, you took out a $1.5 million bond, right? Andrews, no, 1 million. There it is, right there. 1 million, and Baldwin, you took out a $23 million, and Digby 19 million. Chester didn't take out any. All right, well, let's take a look at your products. All right, Andrews, you got some inventory that we're dealing with here. On your traditional, you've got 275, low end is at 879. The other line of traditional 117 and 84 on size. So you got rid of your performance line, didn't you, Andrews? Looks like from what I'm seeing here is you're focusing on, and you only sold 188 of your high end. You're focusing on the low and traditional, aren't you, Rosa? Is that that's your strategy?
We didn't really come up with the strategy. We started to panic and we we're just trying to figure things out. And I think that's just what happened. But yeah, we were really playing with our traditional, with our able. We were really playing with that one.
Yeah, so it's not a bad strategy. If you're focusing at the low end, low and traditional, you're just going after a certain segment of the market. We just want to make sure that your products are going to be positioned where you're going to sell all of them and make sure you have enough capacity so that you can generate the revenue that you need to offset the expenses you have. So yes.
Oh, I was going to say, as far as like, that wasn't like a particular strategy. I think when we were trying to make the numbers work, that's kind of how everything fell. But it's certainly not like something we strategized to do. We were just really trying to, honestly, just trying to figure out how to get in the positive as far as, so anyway, sorry.
Yeah. No, good. So let's see how Robert, can you write some of these numbers down here? Chris, you have a question, please.
Yeah, no problem.
I'll have a question once you answer Robert's question, so like we don't get sidetracked.
Okay. Robert, are you good?
Yes.
Okay, Chris, you have a question?
Yeah, I was gonna say, what's the correlation between future forecast units and then the correlation between that and the marketing? How much money we need to invest in marketing to help us sell those units or future forecast units?
Good question. What kind of variables would you think would go into answering? I don't want to say answering. What kind of variables do you think would need to go into?
Like where you're at in the life cycle?
Well, that's
Market share. I was gonna
Partially.
say market share.
So
Price.
market share, and we're looking at market growth rate, and we're looking at your pricing and your performance characteristics relative to your competitors. So in other words, basically, what is your competitive position? And if your competitive position is a strong one and the market's going to be growing, then the investment in that particular area, given the fact that it's going to have a growth rate, I would think you would want to invest in it fairly strong. You don't want to overinvest in it, but you don't want to underinvest in it. Now, that really didn't give you a straight answer on the thing, other than the fact that, do you remember me telling you guys about the return on investment when you look at your strategic budget, one of them being marketing? You can overinvest, and of course, your return on investment then diminishes. and you can underinvest on it. So it's kind of like hitting that fine line, and knowing where that fine line is really kind of the decision your team is going to have to make, having to do with what you feel your product is positioned relative to the other ones. And again, like I said, what's the growth rate and what's your market share in there? So there's a few variables that you got to look at. Did that answer your question, Chris?
Yes, and then I have a follow-up question.
Sure.
If it's possible, can you show me on the simulation where I would be able to identify those red flags of a competitor? It doesn't have to be my product. I just want to know where I need to look so I can make
Well,
that.
yeah,
determination.
one area that we're going to look at right now is product characteristics, where they are, where everyone is aligned on the different types of segments relative to each other. And are you then meeting the criteria of that consumer? That's really a big thing. When we're looking at strategy and we're looking at trying to sell our products and providing our products to that consumer, we want to make sure that what we're doing is meeting that consumer's need. That's that nasty 4-letter word, the need of that consumer. How well are we matching that need? And so that really has to do with the revision date, the age, the mean time between failure, performance, and size. And then of course the pricing on there as well. So we got 5 different characteristics that we have to consider having to do with what that consumer's looking at and how well we're matching them relative to our competition. So now, Robert, I asked you to write down some numbers for me, right?
Yep.
Okay, so let's do this on your low end. We're going to go here, low end. Let's go the age 3.9.
For Able or for
No,
Acre?
We're gonna go acre, the low end.
Okay,
So let's go 3.9 on age. Let's go mean time between failure, 13,000. Performance 4.3. Size is going to be 17.0 and pricing is 24.50. Okay, that's you guys. Okay. Now let's then go down to Baker. So if you can make another column here with Baker. Are you ready?
yep,
Okay. Baker, age 6.6. Mean time
Okay.
between failure 13,000. Performance 3.0. Size 17, pricing 19.50.
okay,
Let's go
Yep.
down to Chester. Can you make another one for Chester?
Yep.
Okay, here we go. Low end, 6.6 on age, 14,000 mean time between failure, 3.0 on performance, 17 on size, and pricing 20.50.
okay,
And then the last one, we're going to go Digby. For
okay,
low end, we're at 3.4 for age. Mean time between failure is 14. 3.8 on performance. Size is 16.2. Pricing is 20.5. Now, we're just going to do this one, but as an example, so you guys should probably look at each one of your products and their coordinates, write them all down relative to your competition. And now let's go down to see what that consumer is expecting from you on that particular product. So we're going to go to the low end. Here we go. So what they want is this. They want a pricing between 14 and 24. They want an age of that product to be 7.0. They want an ideal position for performance to be 2.7 and the size to be 17.3 and the reliability to be 12,000 to 17,000. That's the mean time between failure.
and this is for this next round, right?
Correct. This is for this next round. So
Okay,
if you're far off on this previous round, you want to
Well,
make
we-
some corrections so that you're not further off on the next round here.
Right. So when we did our numbers, we used this report and we made sure we were in the parameters of each market segment.
Okay,
I think where we are having problems or confused is like um in the production tab and in the I think mainly the production tab. I'm just trying to remember off the top of my head. We were struggling like how to make the numbers work of how much to produce and all, like that's where our struggle is. And then we get to the finance page and it's a mess. At least from our eyes, it's a mess because we don't really still don't, you know, grasp everything that goes into it. You know what I mean?
right.
So I don't know. That was our struggle. But as far as like utilizing reports, making sure we're in the parameters, like I think we did A+ this week on that. We know how to read the reports.
Good.
It's using the production tab and the finance tab,
Let me see if I can do something here for you.
if that makes sense.
Yeah, it does. So I'm gonna log into yours. Can I do that? Log into. you.
Absolutely.
And let's see if we can do this.
Or if need be, I can share and you can tell me what to do.
Decisions, continue to reports. Let's see here. See if I got this. Nope, that's not what I want to look at. I want to go back to.
Which one are you looking for?
Well, I think I went to the wrong one here. I wanted to do.
This is where we struggle finding the reports we want to look at.
Yeah, I know, it's not always.
Because
easy.
they changed the names of them in this 2.0.
There we go. Let's see if we can do this here. Decisions. So your problem was with production, right?
Yeah, like we know how to pull the reports perfectly, but like when it comes to production schedule, buy sell capacity, we tried to put our automation up higher because we wanted that for the future, but like it really messed up our finance page to where, you know, it looked horrible. So and then like we have the unit sales forecast on the top there.
Mhm.
Our numbers are low, so once we would go back into the other tab and adjust our performance and our mean time before failure, and you know, those could change that, you know what I mean, to make it bigger, but
Right. But it's gonna cost you.
right. So yeah,
Right.
like we were back and forth between the production, R&D, and finance. Like we were between those 3 pages for about 2.5 hours and just not getting it.
All right. Well, one thing I'm noticing here with your team is that you guys are undercapitalized. You need to get some money. And you can either sell stock or issue a bond. And don't be afraid to take out and issue a bond. Issuing a bond for $20 million, $25 million is going to give you enough revenue to do those kinds of changes with your production and promotion and marketing that you need to do to sell your products. And you can do the automation that you need to as well. Yeah, I think what you are here is you're just underfinancing your strategic initiative here. In fact, that's what it really appears that you're doing as well, is that you're not capitalizing that. So don't be afraid to take out some money. Spend some money, guys. Think of this as your parents gave you a credit card. Go out and spend some money on a thing.
Yeah.
It will come back. You will make, if you do it right, if you take out enough money where you can make the investment on your production, your capacity, your automation, your product placement, I did say marketing and promotion. It will generate the sales that you want or that you need in order for your firm to have a good turnaround. So but you gotta get the money out. I mean, and that's a common thing with this cap sim, and I do another one. It's called interpretive corporations. One of the big, I guess one of the big stumbling blocks with the teams is that they don't realize that what you're trying to support here, what you're trying to fund, is a corporation with multiple business units. So, and each one of those require significant amounts of investments in them in order for them to perform optimally. So, and that requires a lot of cash. So,
Yeah. And I think another issue too is like, the first week or two, we've driven our company so far in the opposite direction that, once we finally understand how everything works, we're trying to dig out of a hole. Another issue I think that we were having is like where it says earnings per share. We were getting married to the idea that that needed to be a positive thing. And I don't know, maybe we just overvalued things that weren't important. You know what I mean?
yeah.
So just, but simply because we just don't understand, I mean, I still don't understand. And yeah, I don't know.
I'm responding to Jaime. Jaime said, thank God we're not playing with real money. But that's why you guys are playing this game, so that when you're making these kind of decisions, you'll be able to have a little bit more confidence knowing that you got to have the capitalization for your strategy to be effective. That is almost one of the main things. And we're going to be learning about that here in the internal analysis of the firm. What kind of resources do you have available to support your strategy? Yeah, and one of them is what kind of cash do you have? What kind of borrowing capacity? What kind of stock do you have? Those things, because every strategy costs money. I mean, and you're making some big strategic moves. It's going to cost you some significant money when you're playing.
Right. Well, I have get capital underlined 5 times. And
There you go.
so I guess we'll go from there,
Yeah, I think I wrote this. I'm kind of confidence. There we go. Well, I'll send it out and see if it makes any sense to you guys there or not. All right. You guys ready to move on to the lecture? Are we good? Any thoughts? Angela, good? Hey, Angela, by the way, I got your email on those 2 test questions on concept test 2. One of them I did change. The second one, though, the one
I was wrong.
the one having to do with the life cycle.
Right.
Here's the thing. The guy that wrote the book here, and it's an odd thing. He's a strategist. He looks at the life cycle with 4 different stages: emergent, growth,
Right.
maturity, decline. But in all strategic management, and in fact, in the life cycle that you'll see coming up in one of the next few chapters, there's 5 stages. There's 2 growth stages. There's emergent, growth 1, growth 2, maturity, and decline. So when it said stage 3, technically you were right, Angela. So, but I wanted to talk to you first and kind of explain to you that when we go to that life cycle, you're going to see 5.
Oh, okay.
And the reason for that, and this makes sense, when a product is introduced, it's going to go through a rapid growth cycle. Think of the new iPhone 14 when it came out. When
Right.
it first came out, the sales on that were going through the roof, right? Now they're still selling it, but they're not selling it nearly as much as they were when it first came out. Do you guys agree with that?
That's true.
So you have a growth 1 and a growth 2, and there's actually 2 different types of strategies for those 2 different growth periods. So in strategic management, when it comes to the life cycle of a product or a business, we look at the 5 stages, and I know he wrote the 4 there. So if anyone else put down 4, and it was marked incorrect. I'm going to go back into that concept test, and I'm going to change that so that you get credit for that. And the other one, the pull and push strategy, Angela, you were right there. I don't know why I put the wrong answer down on that. I must have just had a COVID moment or something. I don't know. But I'll make that change for you as well. Thank you for pointing that out. I do read your guys' emails.
Well, I was wondering too about, well, not to, I don't really, I'm not gonna sweat the rat tests, but
Right.
the Dodger question is, I looked at that one, I go, there is no right or wrong answer, because you just threw that one in, but I got it
know.
wrong.
Yeah, I know. I just threw it in. All right, we're gonna jump over to the lecture now. All right, let's do that. Let's see here. So can anyone remind me where we stopped?
Yeah, we were gonna do the matrix. You told us to watch the videos.
Oh, the SWOT matrix?
Well, no, what's that one called?
Which one?
Ansoff.
Ansoff, yeah.
Mhm.
So we left off at the start of the Ansoff one.
Oh,
And
but we were in external analysis too, right? So didn't we jump into this as a lecture?
we said we were going to, we were a little bit behind last week.
Oh,
So
we
you
never even
said-
started chapter 3.
Right,
Oh, my gosh. So we
right.
never
But
even
so you
talked
said you
about-
were gonna focus on this and hopefully come back.
Oh, good. All right. Yeah. So we've got a little bit of work to do here. All right. So let me, can you guys see my, my PowerPoints? Can you guys see them? All right. Perfect. All right. So what we're going to be talking about then is the external environment of the firm. This is really critical. In fact, the next 2 chapters, this one and the internal environment, really are those elements that go into the SWOT analysis. SWOT, the strength, weaknesses, opportunities, and threats. And this is critical, but it's more critical than you think, because when we're analyzing the external environment of that firm, we're looking at a multitude of factors that can have an effect not only on our firm's industry, but as well our firm inside of that industry. So, and there's a bunch of them, and that's what we're going to be looking at here. All right, so here we go. So in this chapter, we're going to be looking at the most strategically important aspects of that organizational environment, that external organizational environment. And we're going to be talking about environmental scanning. That is scanning that environment, looking for these factors that can have an effect on our firm. And those factors can be both positive and negative. And then continuing on with that scanning when we monitor these factors to see whether or not those factors are developing in intensity, or whether or not they are shortening their time period, a more rapid approach to having an effect on that firm. So we monitor those factors as well. And then the third thing we do is look at our competition out there. We look at competitive intelligence. What's going on with our competition? Can we identify what kind of strengths and weaknesses they have, and what kind of opportunities and threats they might see? And the 3 of those areas there, the scanning, the monitoring, and the competitive intelligence, they come together to help us do our forecasting. We're also going to be looking at Ansoff's characteristics of environmental turbulence. Some industries are more turbulent than other ones, and it's important then that that firm that is in a higher turbulent industry use a more aggressive strategy than one that is in a low intense environmental turbulent industry. And we're going to be looking at the SWOT analysis. We're going to be looking at the confrontation, the impact probability analysis. We're also going to be talking about the competitive forces. There's 5 forces that have an effect on every industry. I should say every firm in every industry. Some of them more than others, some more having more of an effect than others. And then what's the best way to position your firm so that you can mitigate some of the effects of these 5 forces. Now, these 5 forces are in every industry, so it's important to identify what they are. We're also going to be looking at a strategic group map. This is another matrix that we're going to be doing. The importance of this particular matrix is that it identifies who exactly your competition is. Now, in any industry, you might have hundreds or even thousands of competitors within an industry, but not everyone is your competition. So who exactly is your competitor within that industry? Well, the strategic group map helps to identify them. And then lastly, we look at an external factors evaluation analysis, and how do we gather that information and interpret that information so that it can be used later in conjunction with an IFE, the internal factors evaluation, and give us then our first recommended strategy for the firm. Environmental scanning, simply, it is an internal communication of the external information about issues that might potentially influence that firm's decision-making process. Decision-making process could be opportunity, could be threats. So these are the areas that we're looking at when we're doing an environmental scanning. And if you think of an acronym called PESTLE, that's really what it is. So we're looking at 6 different areas of the external environment: political, economic, social, technological, legal, and environment. And we're going to analyze each one of them to see, of those factors in those different categories, will they have an effect, or could they have an effect on our firm? Let's start off with political. Well, these are those forces that are created by the governments and unilateral bodies. They declare certain rules, regulations, laws, and restrictions. Now, we know, I'm sure you guys have read, that California in 2035 is going to ban all new car sales of vehicles using gasoline. So everything going from 2035 forward has to be something other than a gas-powered vehicle. So now, thoughts. Is that going to have an effect on any industries? Angela, you're on mute.
I
Is it-
said a lot of industries.
A lot of industries, right? So if you are in an industry and you see that by 2035, this law is going to go into effect, and you are going to be adversely affected by this law, you've got 13 years to try and position yourself to mitigate the effects of this law.
I would assume this impacts the shipping companies as well, and every corporation that owns vehicles.
Yeah, right. So that is going to, now, New York and Oregon and Washington and Rhode Island and some of the other states out there have already said that they're going to adapt or adopt California's rules, similar to what's going on here. So it's not just going to be a California thing. This is going to be widespread, and especially by 2035, it's going to be widespread. So, I'll get down. My daughter-in-law brought her dogs in, and they're coming over to say hi to me.
Do you think companies will relocate as a result?
Well, possibly. And actually, that would be an option, wouldn't it? So one of the options that a firm would have, if this is going to have an adverse effect on them, where they are unable to either manufacturing new cars with gas, or whether or not their corporation doesn't want to go all electric and it wants to do something else, yeah, that would be one of the options that they would have to mitigate the effects of this law.
The other thing to take in consideration, is it going to affect the transportation of getting that goods to other states? Is that going to affect the trucking companies?
Right.
The
Right.
trains, planes, all that stuff.
What about gas stations?
Correct.
Yeah. So you can see this particular law, even though it's a few years out, it is going to have an effect. So now some companies are going to benefit from this. Companies that might be making charging stations and any kind of infrastructure that's going to support the electric vehicles, or anything else related to electric vehicles. They're going to this is going to be an opportunity for them. But
Right.
others are going to find this as a threat. Here's some other areas politically that we need to take a look at.
Well, if you get rid of all the gas stations, we won't have any convenience stores to go into.
I know, and then there goes that, that Diet Coke fix that I need in the afternoon, right? Yeah. How about this? Now, this could be, if you're thinking about going internationally, especially with this next one here, government stability and the likelihood of government changes in that country. So if you're thinking about expanding your company and going to another country, one of the things, of course, that you're going to be looking at is how stable is that government? Is it going to have, or are there going to be any changes? Are there going to be any rules and regulations that are going to be adverse to foreign companies working and providing goods and services in that country? So we need to take a look at that. How about level of bureaucracy? That's not only here in the US, which there's enough bureaucracy here in the US as it stands, but in other countries as well. And tax policies, the rate and incentives of tax policies. What about levels of corruption? Now, we may want to think that there's no corruption that occurs here in the US politically. That might be a pipe dream, but thinking about corruption in foreign countries as well. Level of, freedom of press, regulation, deregulation, any control on trade, any restrictions on import, whether it's quality or quantity. Tariffs. Well, we've gone through a series of tariffs within the last few years, and they have an effect on businesses. Now, the thing about a tariff is this, is that when you issue a tariff on products from a company, or from a country, what do you think that country is going to do? What is their natural response when you issue tariffs on products that are coming from another country?
They issue tariffs right back.
Right.
Yeah.
Reciprocity. That's exactly what they're going to do. So what did we gain by doing that? Right? What's the purpose of putting tariffs that are unnecessary? We're just going to have tariffs that are going to be placed on products that
Well, it usually protects one specific industry. So
It
one
does.
lobby group wins and the other one suffers for it.
And what they will do then, the other country will look at a specific industry here, and they will target that specific industry here with tariffs. So it's not that they're done, as a guess. They're
No.
looking at what would be the most effective retaliation on the tariffs that have been placed on them.
We've had
What about-
tariff wars.
Yeah, exactly. What about competition regulation, government involvement in trade unions and agreements? And then we have environmental laws and education laws and consumer protection and e-commerce, and then laws regulating environmental pollution. That's just under political. Let's go to economic. Now we're looking at analyzing national, regional, global economic performance and the trends that have a direct impact on the potential attractiveness of a business that you're in currently, or one that you might want to enter into. Well, one of those things that we'd be looking at would be growth rates. Is the industry growing? What's the inflation rate? By the way, good news today, inflation rate went down, didn't it? You guys hear that? That's a good step in the right direction. What about interest rates? Interest rates seem to have moderated here. I'd like to see them start going down again. How about exchange rates, unemployment trends, labor costs? Well, after COVID, you notice a lot of businesses were out there hiring employees or needing employees, and the employees were less willing to go back to work without getting some sort of a moderate raise from what they had been receiving before. Stage of the business cycle. Well, Angela, that's what we were talking about, that life cycle of the business. Where are we? Are we in the emergent, the growth 2, maturity, or decline? It has a lot to do with your strategy. As we go through those changes, those different periods of that life cycle, a different strategy is going to be necessary. What's the availability of credit? trade flows and patterns? What about consumers' disposable income? And then we look at monetary policies, fiscal policies, whether or not prices are fluctuating, stock market trend. You guys follow the stock market today? 1,201, it went up. That was the biggest jump since 2020. Weather, believe it or not, weather. Well, we know that weather is having a large impact on areas of the country. And actually, weather is having a big impact on other areas of the world and in climate change as well. So those need to be considered. Are we in a business where climate change is going to have an effect on what we're doing, not only now, but in 5 years? Have to consider that. How about social? These are the lifestyle changes that we go through as a group. We look at health consciousness, level of education. What's our attitude towards imported goods and services, and work and leisure and career and retirement? What's our attitude towards product quality and customer service? You notice that our attitudes towards those last two areas, product quality and customer service, we have a pretty strong feeling about how we want products to have high quality and we want to receive good customer service. Those are one of the determining factors whether or not we're going to, consider shopping or buying at that store or buying that product or using that service. And what about attitudes towards savings and investing? What about emphasis on safety and lifestyle and overall buying habits? And then we have religion and beliefs and attitude towards green or ecological products. How about support of renewable energy? Population growth rate. By the way, what is the population growth rate in the United States? What do you guys think it is?
Something like 1.2 or something, some odd amount.
Yeah, it's not very high. I think it's right around 2% or so. Angela, you're pretty close on that.
It's actually below 2.
It is.
That's why I said it's not even 2 kids or 2%.
Yeah. How about this? Immigration, emigration. Well, we've had a lot of discussion on immigration and immigration rates and age distribution and life expectancy. From COVID, the life expectancy in the US went down 2 years. Sex distribution, average disposable income level, social classes. What are the different classes and structures and stratus within our culture? We have those that are super high income. We have those that are homeless. And then in between there, we have that different social structure within there, that level of income that determines the social classes. Family size and structure, and then minorities. So those are all things to be considered about when we're looking at social. Here's technology. Now, technology are those forces that can significantly alter the demand for a product or service and can have a dramatic effect on the environment of a firm. This one needs to be scanned all the time because technology is constantly changing. I'm not saying that the others don't, but this one really, you have to stay up on this because technological changes move so quickly. Things we'd be looking at here with technology, and by the way, technology has often been called an industry killer. Technology, we look at the basic infrastructure level, the rate of technological change, how much spending is done on research and development, what kind of incentives are provided to the technological industry. Looking at legislation regarding technology, what kind of technology exists within your industry and is it increasing? And how quickly is it increasing and adapting to new technological developments? Communication infrastructure, access to the newest technology, and then internet infrastructure and penetration, and then disruption in technological development. Well, you guys remember with GM and Ford, not all that long ago, when they had to stop their production lines because they didn't have enough computer chips. Well, that's a disruption in technological development. Now, did that have an effect on Ford and GM? Can't sell the vehicles. All right, here's the next one. Environment. So we are looking at climate change. We're looking at infrastructure, oil and gas development, deforestation, overfishing, wildfires, flooding, pollution, scarcity of water, and erosion of the soil. All right, those are the 6. Oh, I got one more, I'm sorry. Legal, looking at antitrust law, discrimination law, copyright, patents, intellectual property, consumer protection, e-commerce, employment laws, health and safety, and data protection. All right, I think I'm done. Now, one of the things about these factors, so if we got these 6 different areas, these categories, and we've identified within your firm or your industry that there is within those 6 categories, you got 3 categories where there's a couple of factors in each that could have an effect on your firm. There's a condition, it's called imbrication. It's an overlapping of these causal strands. And what that means is that there's a magnitude effect or a magnifying effect of these factors on that industry within that, or on that firm within that industry. So having an awareness, if there's a few of these or more than a handful of these, and they all are there and are having an effect, you've identified them, positioning your firm might be a little bit more challenging because you're having to deal with more than a single factor, that imbrication of them. Now, Sun Tzu said this: if you know your enemy better than you know yourself, the outcome of the battle has already been decided. And simply what he's talking about here is that if you know more information about your competition than others know about your competition, you're not going to know more than they are. But the more information you know about your competition, the better your strategy is going to be. The more effective your strategy is going to be. Information is going to be helpful. You're always going to be useful knowing what your competition is doing. So, Angela, let me ask you a question. Let's say, I know I may have asked this question last time. Let's say that, Angela, you know what my strategy is going to be on a particular move. Now, knowing that information, Angela, would you consider that knowledge in forming your strategy?
Oh, yes,
Of course.
definitely.
All right, now how about this one? So let's say, Angela, that you know my strategy, but I know that you know my strategy. Would that make a difference with me?
Yes.
Okay, let's go one more step. Let's say that you know my strategy, and I know that you know my strategy, but you know that I know that you know. You see where this can go?
Well, it levels the playing field at that point because it just depends. It's hard to determine at that point whether they're going to stick to that strategy or change.
True, that's true. I mean, they could have a feint move where they would follow a ploy and have you
One
go
of them-
one direction, and
Yeah,
then they go somewhere
one of them
else.
will want the leg up. They want the advantage.
But you see the challenge then with strategy. And one of the challenges is knowledge. And so it really is important. The more you know about your competition, the better off you're going to be. So if I knew your strategy, I'm in a better position. I can make strategic decisions based on that. All right. So that's competitive intelligence. So competitive intelligence is trying to find out as much information as you can about those in your industry, trying to identify their strengths and weaknesses and trying to see what kind of opportunities and what kind of threats that they might have, and see how well you can position yourself relative to what you've identified there. So all of them together, or excuse me, now we're going to go to environmental monitoring. That's simply those environmental scanning factors that we looked at with the pestle and continuing to monitor them. Like that example of the California law that's going to come around in 2035, continuing to monitor that. Are there going to be any adjustments to that? Will there be any lawsuits that are going to be presented that might challenge that law and push it back? So monitoring that kind of information is going to be important for those firms in that industry. It can kind of help them position their firm. So it is important to continually monitor. So moving forward, then we've got those three aspects that go into our forecast. We've got environmental scanning, we got environmental monitoring, and competitive intelligence. And that then helps us determine what our forecast is. And of course, now that we're starting to get some information, we can start looking at the strategic management process. At the beginning, we look at our vision statement and our mission statement. We're doing our external analysis of the firm. Along with the external analysis, which would be next chapter, we're going to do the internal environment. Those together make your SWOT analysis. From that, we can start formulating some strategic plans, analyze the information that we have, formulate some strategic plans. We then implement that plan, and then we look at what kind of strategic options the firm can pursue. So when we do a SWOT analysis, what we're looking then at is assessing the strengths and weaknesses. These are factors internally that you can control. And when we look at strengths and weaknesses, they're mainly around your functional areas of your firm, including your resources and capabilities, and including management. Now, I should add on there as well, capacities. Capacities are important. So how do we define what a strength is? So if Jaime, if you have good customer service and Elizabeth has good customer service, do either one of them have a strength that they can exploit against the other one? Do they? So Jaime can say to those potential customers, hey, we have good customer service. And the customer says, yeah, but Elizabeth also has good customer service. Can you exploit that? So when you're looking at a strength, it's got to be something that is exploitable. Now, Jaime says, I got extremely excellent customer service. And Elizabeth has good customer service. Now that's exploitable. That is then a strength. Externally, we're looking at opportunities and threats. Opportunities are those areas that the environment presents where the firm is able to, by using its resources and capabilities, capitalize on. And threats are those factors that are largely beyond the control of that firm. Political, legal, environmental, technological. Now, when we do a SWOT analysis, we should also try and get as much information as we can on our competition and try and do one on them. So let's take a look at external opportunities, external threats. External opportunities provide that organization with the means to improve its performance, as well as a competitive advantage in that market environment. And also mitigate a weakness. Now that's interesting. If we have a weakness and there's an opportunity out there, how in the heck that we're weak can we use our weakness, or how can we mitigate that weakness with an opportunity? Normally you go after an opportunity with your strength. How can we go after an opportunity with our weakness? Anybody have a thought on that one? Anybody?
In order to improve,
There you go. Who said that?
Gerardo.
Ah, nice job. So let me give you an example on this. Oh, I got a chat here. Let's see what we're doing here. Oh, geez. Ken, are you kidding me? Wall Street Journal says that the gas ships idling off the Europe coast are waiting for prices to go up so they can cash in, huh?
Yes, sir.
Oh, man, that's not good, is it?
It's worth 2 billion.
Oh, gee whiz. All right, well. Taking advantage of everyone, right? All right, so here's an example of a weakness and an opportunity. Let's say that Michael has done a SWOT analysis, and from his SWOT analysis, he's revealed that one of his weaknesses is that he has high manufacturing costs. Okay, relative to his competition, his manufacturing costs are high. But he's also identified, when he did his SWOT analysis, the opportunities out there. And one of the opportunities that he identified was a low-cost manufacturing area. Now, if he takes his company and moves to a low-cost manufacturing area, that actually mitigates that weakness. So when we do a SWOT analysis, what we're looking at is trying to find those opportunities that will mitigate what we've identified as our weaknesses, as well as looking at our strengths, trying to take advantage of those opportunities. And then, of course, external threats, so that anything from the organization's outside environment that can have an adverse effect on your firm's performance. All right. So here we go. Let's take a look at the SWOT framework. Externally, we do the opportunities and threats, and internally, we do the strengths and weaknesses. Together, they make the SWOT matrix. And here's how we do a SWOT analysis. This is actually called SWOT matching. We're going to list our key identified internal strengths. We're going to list our key identified internal weaknesses and the key identified external opportunities, as well as the identified key external threats. And then we start matching them. We match the strengths, internal strengths, with the external opportunities, and we place that matched factors in what's called the SO strategies box. Then we move on to the weaknesses and opportunities. We match our weaknesses and our opportunities, and we record those in the weakness opportunity box. We then go to the internal strengths and the external threats. And we try to look at our threats, and can we use our threats to mitigate any of those, can we use our strengths to mitigate any of those threats? And then lastly, we look at our weaknesses and we look at our threats. Now, this is kind of important. If we're weak in some area and there's a threat out there, we need to work on this quickly. So we put that in the WT, or the weakness threat box. Here's what it looks like. So you can see it's a 9-cell. You got your strengths and weaknesses listed on top, and you got your opportunities and threats listed to the side. And when you go through and do an analysis on your company, try and identify as many as you can. Sometimes you simply, aren't able to identify more than a few. In this particular case, we have 5 strengths. We got 3 weaknesses. We have 4 opportunities and 5 threats. Now, you notice in the SOs area, in that WO strategy, that tan area, all you see in there are numbers. There's nothing written in there. But what it is, it's referring to the strengths and the opportunities, the weaknesses and the opportunities. Yeah, Angela, question. Yeah,
So this is the second time you've showed this, this box,
Oh,
but is it in the book? Because I looked for it in the book and I couldn't find it.
yeah, it's not in the book. Yeah, the SWOT matching is something that is not found in that book. So some of the lecture information that you're going to run across is from a combination of different theorists. Remember we were looking at the 5 different areas of strategic thought, one of them being Ansoff and one of them being the design school. Well, this actually comes from the design school. Now, in your book, I'm sure it talks about the SWOT analysis, but it doesn't show this SWOT matching. Is that correct?
It does, and this is so much better. So this is, and not to digress, but this is one of the questions on the test.
So what does it say?
I'm not going to say because
Oh, you're
it'll
gonna
give out the
that.
answer. Okay.
Oh, okay, all right. So let's take a look at how this works. So we've identified them, and now what we want to do is match them. Now, you can't match everything, so don't Don't try and match everything. Only match the ones that work. So in the strengths opportunities area here, we see that under the first one, so you got a number of 1 through 5 going down on each one of the 4 different boxes there. But in this one here, we do have 5 different listings. Under the WO strategies, we only have 1 matching. Under the ST strategies, we have 3 matching. And under the WT strategies, we have 2. So on the first one, strength opportunity. What we have here then is our strength, unique product. We can match that strength with an opportunity to merge or acquire another firm. Does that make sense to you guys? I mean, we have a strength of a unique product, and we might be able to merge with another company to leverage that, or acquire another company to expand it. Second one, we have access to capital. So we might have a lot of cash on hand, or a good credit rating where we can generate the cash that we need to do our strategies. We can use that to relocate our business if we need to, or, excuse me, relocate our business, or we can do mergers and acquisitions with that as well. Third one, our strength is high quality. We can use that with mergers and acquisitions. Fourth one, technology. Well, we can apply our technology with social changes. And our last one there, company image, again, we can use that with mergers and acquisitions if we choose to follow that opportunity. Now, under weaknesses, we've identified that we have high manufacturing costs. And one way to mitigate that would be to relocate the business or to merge. So there's 2 things that we could do with that one. Under strengths and threats, our strength of high quality can mitigate or reduce the threat of new competition. Technology as well reduces that threat of new competition, and company image can reduce that threat of new competition. And lastly, now we've got weaknesses and threats. We've got high manufacturing costs. So if we have high manufacturing costs, new competition can take advantage of us. So we need to do something with that. That's where we have to convert that weakness into a strength, if we can. We've got the capital, maybe we can do that. Poor marketing, and that's another one that could be taken advantage of by new competition. So that is the SWOT matching box. Now, one thing about a SWOT matching, whenever you do a SWOT, doesn't make any difference the timing on that at all. It is a static look of that firm at that point in time. We know that if you did another SWOT a month from now or 2 months from now, things may change. Opportunities that were listed before may not exist anymore. There may be new threats that present themselves. There may be threats that have gone away, like tariffs. Tariffs may be lifted. So whenever you do a SWOT analysis, it's important to make sure that that SWOT analysis is as up to date as possible. Anybody have any questions thus far? Are we good? I got a chat here. Let's see, who is this? This is Angela. So you're telling him what the question is, right, Angela, on concept test number 2? Nicely done. All right. That's helpful. All right, now, when we did that SWOT analysis and the matching, one of the things that we probably can surmise from that is that some of those matched factors are going to be more important than other of the matched factors. And so the confrontation matrix is an extension on the SWOT analysis. And what it does now, it prioritizes those factors that we've identified as being matched. So we'll work on the ones that have a high priority first, lower priority second, and the least priority we'll do last. And it really is a 1, 2, 3 type of arrangement, 3 being the highest. And here's what it looks like. So we got our strengths, weaknesses, opportunities, and threats listed. There's the areas that matched: strength 1 and opportunity 3, strength 2 and opportunity 1, strength 3 and opportunity 2. Well, those are high priority. So the firm should work on those first. And then we have a threat that we can mitigate with our strength number 3. And you can see as well under opportunities and weaknesses, and under threats and weaknesses, there are also some high priority on there as well. And then again, as I mentioned, the number twos would be the second one, and number one would be the least priority in the order of action on them. All right, now we're not done yet with the SWOT. So far we've done SWOT, SWOT matching, confrontation. And now what we're going to be doing is looking at the external factors that we've identified. That would be the opportunities and threats. And what we're trying to determine here is what kind of impact those opportunities and threats will have on the firm. And then what's the probability of those opportunities and threats occurring? So it's an impact probability chart, 2 variable, looks like this. There it is. Now you notice that the impact and probability, I've marked them on the outside. They could go on the inside if you wish, but however you want to design your chart, this might be easier because if you're entering some data in there. So we got potential impact going vertically on the left, going from low to high, and probability going from low to high on the horizontally on the bottom. And these are both the opportunities and threats. That's all we're listing in here, only the opportunities and threats. So we've got increasing fuel price, recession, low cost rival entering the market. We've got new manufacturing technology, and then the company is going to shift to internet sales as an opportunity. So let's look at them. Increasing fuel price. Well, the probability of that particular threat occurring is low. And even if it does occur, the impact on the firm is also low. How about a recession? Well, the probability of that recession occurring is low. And the impact, though, would be high if it did occur. Here's another threat. Low-cost rival entering the market. Moderate probability of occurring, and moderate probability of an impact on the firm. Now we got some opportunities here. Shift to internet sales. If we did that, if we have the resources and we follow through with that opportunity, the probability of that occurring would be high. We can do it. We've got capabilities and resources to do it. And if we did it, the impact on the firm would also be high. We can also pursue new manufacturing technology. We got the resources, we can do it. So the probability would be high on that. And also the impact would be high on that. Now, here's what the decision makers are looking for. They're looking for the stuff in this area here, that top right area, the ones that have high probability, high impact. They don't care about this stuff down here, and they're really not too concerned about this. They're going to keep an eye on it, but they're not too concerned. This is what they're paying attention to. So now what we've done is we've taken those external factors and we've further analyzed them to see what's important, which one has a high probability and which one has a high impact on that firm. So you can see now from the SWOT, we've done many more areas of analysis than just simply listing the factors. We've done some critical thinking that goes along with that SWOT analysis as well. Does anybody have any questions on the SWOT? Are we good? All right. Okay. I'm not moving too fast for you guys, am I? Am I boring you guys? Rosa
No,
says.
I think those are both like very simple and useful. It's just, I guess, being able to like identify what to put in them is the part that takes time. You know what I mean?
Yeah, it does. It does. You're right. That's really where you, as an analyst, you kind of have to put a little bit of effort into identifying, what can you see would be the strengths? Where are their weaknesses? And from this company's position, do you see any opportunities that might exist out there? And also what kind of threats out there? Yeah, you're right. That takes some time. So if you do a SWOT analysis and you really put some effort into it, and remember, it's called an analysis, so you got to put some time into that thing. It can be an extremely useful tool. And in fact, we're going to be using the elements of the SWOT moving forward in a couple of other areas with our analysis. All right, here we go. All right, let's talk about something called a positioning matrix. This one here A very handy tool. This is kind of a back of the envelope assessment of how your firm is positioned relative to your competition on two variables. Now, the two variables, one must be pricing. It has to be pricing. And the other one is some sort of specialization that is offered by the firm. And that specialization could be things like quality, service, reliability, warranty, brand image, or variety. Anything like that could be the specialization. But remember that one of them has to be pricing. This again is going to be a two variable map. And what you're going to do is plot your firm based on your firm's pricing. Let's say it's a product, okay? Or you can use a firm, general overall pricing, and your firm's general overall, whatever that specialization is. So here's my example on that for you guys. Might be interesting to you. So we have a positioning matrix here that shows 4 different companies: Jack in the Box, Burger King, McDonald's, and Wendy's. And you can see the two variables there going from low to high, or quality, and low to high on price. All right. So from this matrix, it's showing that Jack in the Box has low price and, relative to the other 3, lower quality. What's your thought on that? Does that sound like it's reasonable? Chris, what do you think?
That's funny.
Is that funny?
As far as like getting units out, I think it's pretty good because it's, well, the only thing, it's low quality, but I guess that's the only thing that kills me, but low price is good. I guess quality can be higher. I guess I'd prefer to be Burger King instead of Jack in the Box.
Okay, all right. So you're saying Burger King has got better quality. Right, Chris?
No, sorry, I misread that. It looks like Wendy's got the best quality.
Right, but you were saying, would you eat Burger King over Jack in the Box?
Sorry, I meant to say Wendy's.
Wendy's, all right, okay, that makes sense. All right, good.
Yes.
All right. So also from this positioning matrix, we can see then that quality is a little bit higher with Burger King and pricing is a little bit higher than Jack in the Box with Burger King. Quality, according to this matrix here, for McDonald's is higher than Burger King, but the pricing is less than Burger King and a little bit higher than Jack in the Box. And then Wendy's has higher quality and higher prices than the other 3. Anybody have any comments on those 4 different companies and how they're positioned? Or does that generally make sense? All right, now I'm gonna give you guys a little bit of a pop quiz here. How about that? I'm gonna give you guys some companies and I want you to put on there, or try and position for me, where you think they would be found in the positioning matrix. All right. How about, let's go with Arby's. Where would Arby's be found?
Probably about where the Burger King is.
Yeah, I was gonna say maybe a little to the right of Burger King. 'Cause I think Arby's is kind of expensive. There aren't any near me though.
Okay,
Quality wise, it's more fresher.
so you're saying that quality wise with Arby's is as the same as Burger King or
I
higher?
would say so, because they tend to advertise a deli meat, more fresher meat. I don't know, like
Okay, all right. Price wise,
Pressure process.
price wise, it's higher than Burger King?
yes, that yes.
Okay, all right, okay. Let's try another one. Let's try Chick-fil-A. Where would you put Chick-fil-A?
Oh, above everything. I love.
Yeah.
chicken.
Way
Yeah,
at the top.
Way at the top, way at the top on quality, way at the top on price,
Yes, customer
So-
service, everything, everything.
higher quality, higher price, Chick-fil-A.
Definitely.
All right, let me give you one more, one final one. In-N-Out.
Oh,
Off the chart.
Yeah, it
Quality,
explains
low
everything.
price.
So wait a minute, so when you say off the chart, are you saying off the chart on quality or off the chart on price?
so they're in the upper left-hand quadrant. Their quality is great and the price is low.
Yeah, I'd agree with that.
You guys agree with that?
Correct.
All right, now let's say that you are In-N-Out. And you've just done this back of the envelope type of positioning matrix to determine how well your firm is positioned relative to your competition based on these two variables. is that information that you can use for marketing, knowing that your quality exceeds all the other ones on this matrix and your pricing is lower than the others on this matrix. Can you use that in your marketing?
I feel like you could use it in like a talking shit kind of way, which I've noticed lately a lot of companies are. Like Wendy's Twitter used to be amazing to watch.
I think it's hard too, because I think all of these other fast food restaurants, they have more products to compare, like than In-N-Out. All they have is burgers and fries. Like they don't have any chicken, they don't have any salad. So it's kind of hard to put them in the same category because like they have less stuff to
Yeah,
sell.
that's true. So they pretty much focus on, just certain areas, right?
Yeah, they're just focused on hamburgers and fries and their shakes, and that's
And
all they're focused on.
they don't have a lot of marketing because I think they sell the food and the product and the customer service actually sells itself.
Yes.
I don't think they have as high marketing costs as everybody else because those others are competing to stay in a market, with subpar performance.
Yeah,
Or-
So
good point. Very good point. Yeah,
But also too, when you look at these are all, it just threw me. In-N-Out is private. It's not franchised.
Right.
It's privately owned. You got to look at that too, because that makes a big difference.
yeah. So yeah, one of the things that In-N-Out focuses on is maintaining their quality because it is not franchised.
Mhm.
All right, good. Well, that's an example of a positioning matrix. All right, we're going to jump over to Porter's 5 forces. Now, at the beginning of the lecture here, I mentioned to you that Porter's 5 forces exist in every industry and has an effect on those firms in that industry in their ability to set their pricing and, of course, by extension, determine their profitability. So we're going to go through each one of these 5 forces and kind of explain what they are and how they can have an effect on those firms within that industry. We're going to start off here with suppliers. Now, suppliers are those companies that supply your company with the products or the services that it needs or that you need in order to complete its final project or product or complete its service. So these are the things that you are getting from someone else to help you make your product or service. They have more power now when there's only a few suppliers out there and there's a lot of buyers that can buy from them. And so they can go then to different companies to sell their products because there's only a few suppliers and there's a lot of buyers out there that need what these few suppliers are providing. Now, another one is substitutes. There's few substitutes available. You can't use something else instead of what this supplier is providing you. So you have little choice but to buy from those suppliers. Here's the one that's really important. That particular product is the most effective or most unique to that buyer. So if that supplier then says to your company, well, the cost of this particular part is going to go up by 15%, what choices do you have? If this is the one that is most unique, most effective, few suppliers out there, and there's no substitutes or few substitutes available, what choice do you have if they say we're going to raise our price 15% to you? Robert, what do you think?
I think that you don't really have a choice because they have the market cornered, correct?
Right. So if they say we're going to raise the price by 15%, your choice is this: either absorb that, there goes your profit by a portion, right? Or you're going to pass that on to your customer. So when we talk about suppliers having an effect on your firm's ability to set your pricing and then determine your profitability, there's a good example right there. Here's another threat from suppliers that makes them more powerful. When they have alternative customers, when they have alternative industries and alternative channels of sales that they go through. They don't need you. And if you say, no, I can't afford to pay that, they're going to say, fine, okay, well, we've got other places that we can go with this. And the last one here is when that supplier, and we'll be talking about integration strategies and corporate level strategy, can integrate forward. So when we're talking about integration strategies, we're talking about that value chain, that supply chain, going from raw material to that finished good, and all those linked set of value creating activities. Well, the supplier would be a link in that link set, and they're the ones that are providing that to you. And if they can move forward, actually go into your position, that's a threat. Robert, you raised your hand. What's up?
I just wanted to add something too, like if you have a superior product, you may have alternative channels, but like take something like Amazon or Walmart. Sometimes your power is diminished if you want to get to a different level as far as distribution. You know, you may have the best product, but if they're not going to carry your stuff, you know, it seems like the supplier has more power than the bargainer.
Yeah, yeah.
If you want to be big, like huge, you know.
Now, let's see, I got a chat coming in here. Yeah, Brian, In-N-Out does have grilled cheese. You're right. No, yeah, they're
Hey,
good there.
Professor, I'm sorry, adding with that with Robin, what you're saying, can we kind of, something came to my mind, kind of like Starbucks. Starbucks is mainly coffee, and they get their beans from a particular supplier. They're kind of stuck if, hey, the supplier wants to say, hey, we are going to raise our cost by 15%. They're kind of stuck, aren't they? Because they need that particular bean from that particular supplier, because that is their copyrighted type of coffee.
That's the one that is most unique to the buyer, right? Isn't it?
So am I in the right direction with this? It just,
Yeah, you are.
It just threw in my mind. I don't know why, but it just did.
Well, you are. Now, the only protection that Starbucks could provide themselves is if they provided some sort of contract with that supplier saying that, okay, over the next X period of time, we're going to be buying X quantity of coffee beans from you at this guaranteed price, and then we'll renegotiate the contract at the date that it expires. That might sound like something that Starbucks would do, given the fact that they buy so much, and it would protect them going forward. But not.
Do they do exclusivity, whatever?
Yeah, they would
in their
have to do that.
contract too.
Right, yeah, they would say part of this contract is that you sell to us only and not someone else, right? Yeah, that would be part of the contract.
Now, let me ask you this, because it's just coming in my head. Mickey Mouse, his copyright is going to be coming up soon. What does that do?
Okay, I didn't hear that one. What was that again?
Okay. Mickey Mouse, Disneyland's Mickey Mouse came to my head right now.
Right.
Their copyright's going to be up pretty soon. The term for the copyright is going to be expiring soon. What is that going to do for Disneyland? And Disneyland is international. So what does that do for them?
Well, first of all, I didn't know about the copyright coming up.
Yeah, I did a paper on it not long ago. Disneyland's going to come up, I think in 2025, I think, or 2024.
Copyrights only last like 75 years and that they expire.
Wow. Well, that's going to be interesting. I'm going to have to look into that. And the answer is I don't know how they're going to carry that forward unless they're going to try and, well, even if they try and change it a little bit and try and issue another copyright, that other one's going to be out there, and that's the one that everyone recognizes, right? That's going to be interesting. Wow. Learn something new. Let's take a look at okay. Bargaining power of buyers. Now, when I do this one here, I want you guys to think of Costco. Costco is a buyer, right? So when Costco is out there buying, and when you look at Costco and you maybe look at some of the other large, what's the one that Walmart has? Is it Sam's Club, right?
Yeah.
So you have few buyers and you have many supplier options. So Costco and Sam's Club, they can buy from a lot of suppliers out there. They can pick and choose with whom they want to buy their materials to stock their stores. The buyer purchases in tremendously large volume, and when they do that, they're going to demand better pricing. And that just makes sense. You know, if you're going to buy 100 of something, you're going to get this price, but if I buy 100,000 of them, I want a significantly better price. The supplying industry is made up a large number of moderate operators, moderately small to medium-sized operators. The buyer's product, Costco and Sam's Club, the product is not differentiated. It's not unique. It's mainly a commodity, and they can easily play one supplier against the other supplier for pricing, because they're basically, what's going on in there is generally just commodities in there. Now, I realize that Costco and Sam's Club do have these one-off that are kind of unique in there, but for the most part, they're mainly commodities. Switching costs from one competitor's product to another is going to be low and simple or non-existent. I can switch from one supplier to another supplier, and it's not going to cost me anything to do that. The supplying industry operates with high fixed costs. In other words, they have to sell their product in order to make a profit to pay their bills or make revenue to pay their bills. So there's more of an impetus on them to sell their product. The buyers, that would be the Costco and Sam's Club, have low margins. They're very, very price sensitive, and they're tough negotiators. And then the last one here, the more information that buyer has, the better his bargaining position is going to be. Remember, I just said, the more information you have about your competition, the better your strategy is going to be. Well, if you know what your supplier's costs are, you then determine what their profit, what would be a fair profit for them. If I know that Zach's costs are $100 for this particular product, maybe I'll pay him $115. That's 15% profit. Maybe Zach was normally going to sell it at $175. But if I know what your costs are, it's difficult then for that supplier to negotiate and say, well, that's, you know, our costs are higher than that. So that's buyers and how they can have an effect on the pricing and profitability of the suppliers. Let's go to the next one here. This is threat of new entrants. Now, this is kind of an interesting one. When we're trying to determine the threat of a new entrant, what we're looking at are the barriers that exist within that industry or that market. The higher the barriers, the lower the threat. The lower the barriers, the higher the threat of entry. So let's take a look at what some of the barriers to entry might be. Economies of scale. So those in the industry have already achieved economies of scale. In other words, their price structure now is lower. So to enter into that industry as a new competitor, you're going in at a disadvantage because they already have an advantage over economies of scale. Going into an industry where you're going to be competing against products that have brand name recognition and loyalty is going to be difficult. We're going to enter into this industry, and there are already those in the industry that are well established. Customers know them. They don't need to do much promotion and advertising and marketing because that product, for the most part, sells itself. We're going to have a problem. That's a high barrier. Of course, we know about upfront capital costs. That makes it difficult for them to enter. Switching costs that exist within the industry. New customer comes in and there's a switching cost going from one supplier to, or one provider to another one. If I want to leave this company and go and buy from you, there's going to be a switching cost. Now, switching costs may not seem like something that you're very familiar with, but if you guys have Verizon phones or you have some other phone company and you want to switch from that company to another one, there's a switching cost there. Access to distribution channel. They may already be sewn up by the people that are in the industry. So it's difficult or even restricted legally. And then those in the industry might have patents, licenses, proprietary knowledge access to raw material, capital assets. They have the experienced workers necessary for that industry. They might have subsidies that are provided to those in the industry, and that creates a high barrier. And then also there might be an industry that they're in that has, it's regulated by the government, requiring operating licenses. That would be a barrier as well. The last one is that when you're entering into an industry and you are, now we're going back to Angela's industry life cycle, and we're looking at the mature stage, or we'll be looking at the growth 2 entering into mature stage. When you're in that particular stage of the market where the growth has slowed down and is starting to become mature, if a firm wants to enter that industry at that time, you are going to get retaliation. That is a guarantee that they will retaliate against you. So that would then be another barrier to entry. Of course, the more barriers to entry, the threat of entry is low. How about substitute products? These are products that can be easily found. They do the same thing as the original product. They have the same quality, same pricing or better. And there's a lot of them available, substitute products. So if you have substitute products out there and they're less expensive, that's going to have an effect on your firm's ability to set its pricing and determine profitability. Now, one of the big dangers of companies that provide substitute products is that it might be a product that they can offer as a loss leader, and they can put it out into an industry, keep the costs down, or keep the price down, and have those others competing in that industry compete against that product at a lower price to them, where they can make up, the original company can make it up on other lines of products. Here are some substitute products here. You've got almond milk as a substitute to fresh milk. The reader is a substitute to the books. And then Uber was a substitute to the taxi. Now, when Uber came out, did it have an effect on the taxi industry?
Absolutely.
Yes, it did.
Yeah, pretty much destroyed them.
Yep. And what we have now is just a ride sharing company. Pretty simple idea. And it had a big impact on the taxi companies. So there's what we're looking at as an effect of a substitute product.
Professor,
Last one here is industry rivalry. Yes, go ahead.
I was gonna say, didn't it expose like a flaw in the New York system taxi, or in the New York taxi system, where they used to have to like have medallions, and that was the only way you were able to the taxi driver?
Yeah, and in New York, you had to pay a lot of money to get a taxi medallion. And of course that, and of course within that, you kind of, everyone charged basically the same rates for their cab fee. And so it made it like equal competition for the taxi cabs, and then comes along Uber, and Uber just destroyed that concept of, going from point A to point B using someone else to drive you there. Yeah, good point. Last one, industry rivalry. Now, industry rivalry does have a big effect on profitability and pricing. Rivalry is high in an industry when there is a number of small or equal competitors. So if everyone in the industry is about the same size and we're all competing on the same competitive characteristics, price, quality, service, we're going after the same customers, going after the same geographic area. All of our competitive characteristics are the same. We're basically the same company. And if the products that we offer to those consumers out there are basically commodities, we're selling them on low price, not differentiated, those consumers out there can go from company A to company B to company C and get their product that they want based on the low price that they see advertised from these different companies. Those customers going from one company to another one, there's no switching costs. So there's no penalty if they shop at one company and go to another one for their commodities. As I mentioned, the companies all have the same strategy. The industry, here's a big one, has low growth rate. So if we're talking about low growth rate, we're talking about a mature industry. Growth rate in mature industry is around 2 to 3%. And those who are in the industry find it difficult to get out of the industry. So the exit barriers are high. They're hard for them to get out. And lastly, those in the industry have high fixed costs. So they got to generate sales in order to pay their fixed costs. And to generate sales, they've got to try and sell their product to those consumers and pull those consumers away from those in the industry. So the only way you can really grow is to pull the customers from someone else. That's really a challenge here. So let me give you an example here. Let's say that Gerardo and Jaime and Rachel are all in the same industry. And you guys are all selling the same product, and you're all selling that particular commodity at $100 to that consumer. Now, remember, your strategies are all the same. You're equal when it comes to the ability to market, to promote, to quality is the same, customer service level is the same. In other words, all you've done is really taken your name of your company and changed it to another name, and that's the other company. The customers are buying from you because of the fact that that particular product has low price. All right, now, Gerardo, you want to grow. You got high fixed costs, Gerardo. How are you going to take customers from Jaime and Rachel? Because your growth rate is only 2 to 3%. You've got high fixed costs. You need to pay your bills. You want to try and grow. Price of your product right now is at $100. What would you do?
Well, first of all, I'll outsource to a different company to get it cheaper. That way I can lower the price.
And Jaime and Rachel can do the same thing. Remember, your strategies are the same. Your resources are the same. Whatever you do, they can do. And in fact, strategic decisions at this point in the industry life cycle are made on a reactive change rather than proactive. So whatever you do, they're going to do. So that was a good idea though, Gerardo. I actually like that a lot. But if we can't do that, what's our other option here? How are we going to pick up customers from Jaime and Rachel another way?
Improve the quality of the product.
Nope, their quality is the same and they can do the same thing too. I like the way you guys struggle. There's only one option.
Create more products.
No. Go ahead, say it. Somebody say it. What's the thing you can do to get more customers? How can you take customers from them when they're price sensitive and what you're selling to them is a commodity?
Marketing, advertising.
No, that's not the answer.
Promotion.
What is it? No, what is it? Pricing. Pricing. You want customers, Gerardo? Your customers out there are buying from you because of your low price. And if you want more customers, you lower your price. So if you lower your price from 100 to 90, Jaime's customers and Rachel's customers, because they're buying that product based on price, are going to go over to you. That's where they're coming over. Remember, this is a commodity, guys. There's nothing special about this stuff. Now, Jaime, Rachel, go ahead. I love it when you guys try and struggle on this thing here because there's only one option. Show why your product is better. Brian, that's marketing. They're going to try and do that too. But you want to grow, you got fixed costs. You're in a mature market. So you lower your price to $90. Now you're picking up sales, Gerardo. You got revenue coming in, and Jaime and Rachel, you're losing sales. Looking at your sales number and they're diminishing, and you're trying to figure out what happened. And then you realize that Gerardo, he lowered his price and you're losing customers. Jaime, Rachel, what are you going to do?
It'll be another Black Friday sale.
There you go. Jaime, there it is. So you're going to go from 100 and he's at 90. Where are you going down to?
85.
There you go, buddy. All right. Rachel, oh, you're really losing because you're at $100 right now and Jaime's at 85. Your customers are walking out your door, going over to Jaime's company. What are you going to do, Rach? Is she there? Well, maybe we can go Elizabeth. Elizabeth, are you there?
I'm right here.
All right. So
What
you're
am
gonna,
I gonna do?
yeah,
that what
you're gonna take Rachel's place. So
Okay,
Jaime went down to 85 and now he's getting the customers back from Gerardo.
I'm going down to 80.
80. Woo-hoo. Wow. We've got a
Not even
price war
2
going here, don't we? All right. So let me ask you this question. First of all, is our ability to make profits and our pricing, has it been affected by industry rivalry? Yes, it has.
Yeah, directly.
Oh, yeah.
Our ability to-
Yes.
Yeah.
You can look at it this way. When you go on the street and there's 4 gas stations on each corner, I see it happen over here where I live in West Covina. The
Uh-huh.
one gas station will drop it 1 penny. The other gas station will drop it 2 pennies. Maybe the Chevron will hold on a little bit, and then the little independent one will totally drop it, and then you'll see Chevron match to the one that is the lowest.
Brian
It
says,
ha- it's
yeah, good. Yeah, and you're right. Yeah, and that's a good example. Brian is, he says that he would go to 82.99. So nicely done there, Brian. So let me ask this question. Who's actually winning here with the 3 companies?
The consumer,
Yeah,
Yes.
who's losing?
all 3 companies.
All 3 companies. Now, oddly, this does exist in industry and there's a term for it. And so it exists enough that they've even given it a term. It's called profitless prosperity, where your revenues have gone up. So in this particular case, now that we know that Brian is at 82.99, his revenues have gone up, but has his profits gone up? So with profitless prosperity, the revenues go up, but the profits go down and actually stagnate or turn to loss. So it is a condition that does exist. It exists enough, it's not rare, that they've even termed it for you. All right. So those are the 5 different forces that are found in industries that can have an effect on the firm's ability to set its pricing and determine its profitability. Well, there is a 6th one. It's called a complementer. This really came out back when the smartphone came out. Actually, it was known before the smartphone, but it really took significance when the smartphone came out. I mean, there's been complementers that are found, and I'll give you an example of them, that are found in industry all the time. And you see them, one product complements the other one. But when the smartphone came out, especially the first time when it came out, like when Apple came out, there were applications that were developed for that specific operating system. And then there were applications developed for other operating systems when they came out. And those applications at that point, early on, didn't really transfer or didn't transfer. And so a complementer at that time would be one of those products added to that phone that would create a barrier from another company pulling that customer over to their phone. So that consumer would go, well, wait a minute, I like this app that's on my phone. And because I like this app so much, I'm going to be less willing to switch my phone to that phone. Now, we know right now that all the applications that are developed are cross-platform. They work on all of the different operating systems on the phone. But let me give you another example then of a complementer. There we go. We got coffee and Coffee Mate. We got hot dog and hot dog buns, right? Those are complementary goods. Now, let me ask this question. If the price of Coffee Mate goes up, will it have an effect on the sales of coffee? Elizabeth?
Yes, I would say a little bit, but you still need the creamer to go with your coffee. Or some people who use a lot of it. Or they have to use less of the Coffee Mate, I guess.
Okay, anybody else? Any other thoughts? Zach, what do you think? If the cost of Coffee Mate goes up, will it have an effect on coffee?
I think it would, because I'll only drink coffee with the blue Coffee Mate.
Oh, okay.
Well, then you just go to some fast food and use all theirs.
Just do it.
You steal toilet paper from restaurants too, Angela.
I mean, honestly, I don't think it would. Like, I think if people like coffee, they'll drink coffee.
Right,
Yeah, I
right.
think the
Actually,
creamer is just something nice to have.
yeah, that's the relationship between the primary good and the complementary good, is that the primary good, if the price of the complementary good goes up, it has no effect on the primary good. Now, if the price of coffee goes up, will it have an effect on Coffee Mate?
That, I would agree that it would.
Yep. So there's the relationship between the two. All righty. Now I have for you here, I provided this for your final paper, a 5 forces checklist. And here you go. You can go through each one of these different areas and determine whether or not that threat exists for new entrants, for buyer, for supplier, for rivalry, and for substitute products. All right. Well, you know what? We've been talking to, and here's one more you can go with. You can kind of take that information from the previous one and bring it over here, and you can determine whether or not that industry is attractive or not. So look, we've been going for 2 hours. Why don't we take a break, okay? Go grab something to eat, and I'll have you guys come back here. Can you make it in 15 minutes? Is that cool? Does that give you guys enough break? Go to the restroom and get something to eat and go make yourself a martini? No? Not going to make yourself a martini?
Yes, I am.
Oh, Brian says yes. Yes, I'm going to go make a martini. There you go. All right. All right, guys, I'll see you then at, let's go to 7:45. That gives you 20 minutes. All right. All right. I'll see you guys in a bit. You guys ready? Ready to start again? Rosa, you're right there. Robert's there. Gerardo's there. Jamie's there. Time for tequila shots for all veterans. Yes, thank you for your service for all vets. Very cool. Hey, what we're going to do now, I'm going to push by that strategic group mapping because I want to get into the competitive profile matrix and then the external factors evaluation. Next week, before we start the internal factors evaluation, I'm going to come back here and look at the strategic group mapping. I wanted to get these other two in first because I know that it's getting late for you guys tonight. So we're going to start with competitive profile matrix. Can you guys see my my PowerPoint slides? Are we good? Excellent.
Yes, sir.
All right. This is actually a really, really useful tool. In fact, whenever I do an analysis of a firm, this is one of the matrices that I use. And primarily the reason I like it so well is that this is one that all the information is driven by the owner and those principles of that company. They're the ones that determine what's important and how well their firm is positioned relative to others. It's really, really a useful tool. All right, here's what we're going to do. Take a look at how this thing works out. First of all, what we need to identify is critical success factors. Now, in every industry, there are factors that are critical to the success of that firm in that industry, critical success factors. So as an example, let's say, Christopher, you own a restaurant, okay? LA King's Restaurant.
Perfect.
Christopher's LA King's Restaurant. All right. Now, Chris, what would be one of the things that would be important for your restaurant to be successful?
Quality,
Quality of what? Food?
quality of food, quality of service.
Okay. So
Also,
we got food and service. There's two things you've listed. Keep going.
jumping on the In-N-Out wagon, accessibility.
Okay.
Making sure people have access to get into the restaurant.
Sure, exactly. All right. So when we're looking at critical success factors, Chris just named some that are critical. If you're going to own a restaurant, you better have good food quality. If you don't, your sales are going to suffer. Does everyone agree with me on that one there? Right. And also quality. Now, it's not only just quality of the food, but quality of the atmosphere of the restaurant, the service that's being provided to them. How about cleanliness of the restaurant? Is that important?
Absolutely.
Sure it is. And location, Chris pointed that out. You have to have accessibility so those customers are able to find your restaurant, have good parking, right? Maybe there's some ambiance to that. Maybe you have an ocean view, maybe you have a mountain view, whatever that might be, that it'll add to that firm. That could be a factor that could help it be successful. All right, so we agree then that there are certain factors that a firm needs to attend to in order for them to be successful. Critical success factors. Every industry has different listing of critical success factors. Here we go. A restaurant, we talked about customer satisfaction, market share, employee turnover, food quality, price, location, and service. If you are a car dealer, maybe sales volume, customer satisfaction, market share, diagnostic accuracy, and location. So you can see that there's different lists for different types of industries. So what we need to do is then for that industry is identify what are those factors that are critical for that firm to be successful. And then we list them. So here we go. Here's how we do it. So we list anywhere from 10 to 15 of these critical success factors. Now we know some of these factors are going to be more important than others. Like in Chris's case, food quality is probably going to be the most important one. Location is important, but is it as important as food quality? Most likely not. And then we have other things like customer service. Yeah, that's going to be important up there. Cleanliness, most certainly. How about pricing? Well, pricing is important, but is it as important as food quality? Maybe, maybe not. So what we do then is we look at all these different factors and we try then to rank them or rate them as far as their importance, giving that factor that is the most important the highest weighted value. Now, all of our factors have to total a 1.0. And then what we do is we rate our company based on how well we're doing on those factors. So let's say, Chris, you're rating yourself. And this is what's really neat is when I do this to a firm, I will ask them about, in this case, let's say it is a restaurant. So tell me about your food quality, going from 1 to 4, 1 being a major weakness, 2 being a minor weakness, 3 being a minor strength, 4 being a major strength. What about, how is your food quality? And Chris says, well, one of the things about our food quality is we got a great chef here and our food quality is excellent. Fine. We give that a 4. And then we talk about the other ones. What about pricing? Well, our pricing is a bit high relative to the competition. So it's not a weakness, but it's a minor strength. Okay, we'll give that one a 3. And we go through each one of the factors and we give them a rating, 1 through 4. And then we multiply the weight times the rate and we come up with a weighted score. Now, here's the advantage of this, is that we do this to our competition too. We don't have to list the factors anymore and we don't have to give them the weights anymore because they're already established. But now I'll ask Chris, I'll go, okay, Chris, tell me about Robert's company, Robert's restaurant. How is his food quality? And Chris goes, well, he's got really good food quality, but our food quality is better than Robert's. Okay, so we're going to give Robert then, instead of a 4, we'll give him a minor strength of 3. What about his location? Oh, he's got a fantastic location over there. So we'll give him a 4 on that location. And we do that rating all the way down on each one of those factors, and then we multiply them and we get a summed score for his competition. Now, you should do this on at least 3 competitors. Okay. Here's what it looks like. So we have Apple, HP, and Dell, and these are those critical success factors here. And you notice that the weights on all of it totals to be a 1.0. Some of these factors have more importance than others. So we got a 0.15, 0.15, 0.15. That's on customer loyalty, product quality, and financial position. And we got a 0.14 on innovation. And we got some that are pretty low. Web development, 0.05. So it's important, but it's not nearly as important as the other ones. And the rating on this, market share, well, that's a minor weakness for them. Pricing, minor weakness. Financial position, minor strength. Product quality, minor strength. Customer loyalty, major strength. So you can see with Apple, they've got some strengths and they've got some areas that they need to improve upon. They got some 2s and 3s in there. You take the weight times the rating and you get a weighted score. And then we sum this. And then we do the same on our competition. Now with HP, we can see that on some of these, they got some 3s and there's some 2s and 3s and 2s. And then HP, or excuse me, Dell, they've got some 4s and some 3s and 2s. So overall, it looks like then when we're looking at a competitive position here, Dell has a 3.16, we have a 3.05, and HP has a 2.30. Now, if we're looking at a scale of 1 to 4, a 3.05 is not bad, going on a scale of 1 to 4. Neither is a 3.16. 2.30, there's some work to be done. The main thing from this particular matrix is to identify where you're strong and where you're weak. So we've got some weaknesses here. We got some 2s here that we might need to work on, like advertising. Can we put some money into advertising and change that from a minor weakness to at least a minor strength? Global expansion. Well, if we have enough resources, maybe we can attend to global expansion and try and improve that one. And then can we exploit those areas of our strengths like innovation and our customer loyalty? So we're looking at then, when we do this, the areas where we aren't performing well and the areas where we are performing well. This is called a competitive profile matrix. Anybody have any questions on the CPM? Really straightforward, and it's extremely useful because, as I mentioned, it is really filled out by that customer. All right, here we go. We're jumping into the big one now. External factors evaluation. Now, from your SWOT analysis, remember we did our strengths, weaknesses, opportunities, and threats, and Rose is going to love this one because this is a cool one. We are going to list only our opportunities and threats. Again, opportunities are the chances in the environment that the firm can exploit with its resources. And the threats are those areas of that opportunity that are negative that can have an effect on the firm's ability to perform. So here's what we do. We list then in column 1 all of those external factors. So if we have a SWOT and you have 6 opportunities and 6 threats, we're going to list them on here. So you're going to have 12 of them. In column 2, we're going to give those factors that we've listed a weighted value relative to each other. So we're looking at the opportunities and their threats and the threats, and we're trying to determine then, based on what we've listed here, which one is the greatest opportunity or threat with those listed. That's going to have the highest weighted value. Again, all the weights have to be a 1.0. And then we're going to rate. Now, the rating on this is not how great of an opportunity it is or how great of a threat it is. And this is important. It's on how the firm's ability to respond to that opportunity or to that threat. What's the firm's ability to respond to that opportunity, going from 1 to 4, 4 being outstanding, 2.5 being average, 1 being 4. And of course, anywhere in between there, you can put a number. So let's say it's above average, you can put a 3 or a 3.5 in there. It's below average, but not poor. You can put a 1.5, 2 point in there. So anywhere you can put any number in that continuum there. And again, it's based on the company's ability to respond to that factor. We take the weight times the rating, we get a weighted score, and we're going to need that final number because that final number is going to be used with the final number from the IFE to be plotted on a matrix called the IE, and it's going to give us our first recommended strategy. So here's what it looks like. This is the external factors evaluation. We got our opportunities and threats listed. These came right off your SWOT. Now we're giving them a weighted value based on their importance. You can see here that this opportunity here has a 0.15. It is more important than this opportunity down here. Increase sales of the laptop by 20%. So you can see some are more important than others. Now we're looking at the firm's ability to respond going on a 1 to 4. And in this particular case, Apple's doing pretty good because everything here is at 3 and 4. So their ability to respond to all of these opportunities is high. Take the weight times the rate, get a weighted score. And the threats, we do the same down here with the weight. Remember, all of it, opportunities and threats totals 1.0. And we're looking at the firm's ability to respond to the threats. Now, some they're doing good on, 3s and 4s, and some they're not doing also well, a 2. All right, so we take the weight times the rate, and we come up with a weighted score. And there's our number down here, 3.24. We're going to use this number, as I mentioned, in conjunction with the IFE to give us our first recommended strategy. Anybody have a question on the CPM and on the external factors evaluation? Robert, you good? Good. Chris, you good? All right. Rosa, how about you? You good? Or am I going to get an email from you at 3 o'clock in the morning asking me? Michelle's good. All right.
Yes, I'm good.
All right. Hey, I noticed that a couple of teams have submitted their financial and also their strategy. Your grades are already posted in the grade book. I got a chat here from someone. My family just got home. Robert, your family just got home. Great. I'm done with you guys here. It's 8 o'clock. And if you want to take off, Robert, you can. Okay. Are you good? All right, good. Oh yeah, restaurants, military discounts. There we go, guys. That's tomorrow. All right, we are done with this particular lecture on external environment. Now, next week when we start, I'm going to go into the strategic group mapping. The reason I didn't do that is because what you guys need to do is the CPM and the external factors evaluation. There's no requirement for you to do the strategic group mapping. I wanted to get those out of the way so that you know how to do them. Anybody have any questions? And if not, you are good for the evening. Have a great Veterans Day. And again, for you veterans, thank you for your service. Enjoy your day. Go get a free dinner, free lunch, I think. Whatever you can get free, get it.
Thank you.
Yeah.
Thank you.
And yeah, you're welcome, guys. Zach, you're still up there, aren't you?
Yeah, I get home Sunday though, so.
Okay. Oh, that'll be nice.
Oh, yeah.
Yeah.
Yep.
All right, guys. If not, then I will see you next Thursday. If you have any questions, text me or email me, and I try to get back with you right away. And I hopefully those who have done that, except for Angela, I don't get back with you at 3 o'clock in the morning. But the rest of you guys, I do. Have a nice evening, guys. All right.
You too.
Bye now.
Thank you.
For your
Yeah, you're
service.
welcome.
Thank you, Professor.
You're welcome.